This video, created by the University of Missouri Agricultural Business and Policy Extension Program, provides information on flexible cash rental rates. One of the challenges of developing a satisfactory lease is mitigating risk. Typically, reward increases with greater risk. Each party in a lease has a different perception of and tolerance for risk. It may require hard work to arrive at a fixed cash rental rate satisfactory to both the landowner and the tenant. They do not split the risks and rewards between the two parties. Regrets may arise when prices or yields deviate significantly from what was expected. Share leases require more attention during the production season as landowner and tenant are sharing input costs and grain revenue. Deviations from expected yields or prices are shared between both the tenant and the landowner. The cash outlays required from the landlord and the amount of communication between parties with share leases discourage some from using them. Flexible cash leases or variable leases are a hybrid of fixed cash leases and share lease agreements. They were developed to try and incorporate the risk-return principle into leases without the major challenges of share leases. Landowner regrets from having a rental rate that does not obtain some occasional windfall profits in agriculture are lessened with flexible cash leases. Flexible cash leases also keep tenants from overpaying when revenue from farming falls below expectations. Flexible cash leases share both the risk and the occasional high return from farming. Flexible cash leases can account for changes in yield, commodity price, total revenue, or some estimate of margin. Flexing on total revenue is the same as flexing on both yield and price. While many ways to flex a lease exist, we will focus on using total revenue. Flexible cash leases consist of a base rent paid to the landowner plus an adjustment upward if crop revenue exceeds the amount of the base payment. A clear understanding and agreement on the base rent and the adjustment factors promotes a satisfying lease. A maximum rental payment is also common in flexible cash leases. This may limit the adjustment to a certain dollar amount or to a percentage of the base rent. Maximum rental payments prevent the tenant from having cash flow challenges resulting from paying a high final rent amount. Typically, the base rent is the lowest amount the property owner can expect to receive. The final rent adjustment is a bonus paid in addition to the base rent. Not setting a guaranteed base rent can cause the lease to be viewed as a share agreement for tax and government program purposes. Most businesses using flex leases prefer to have their lease viewed as a cash lease. Several factors influence the choice of the base rent. One of the simplest ways to set the base rent is to set it at 60 to 80% of a typical fixed cash rental rate. Because the base rent is less than a typical cash rent, the landowner has the risk of lower income in some years. The landowner typically receives the base rent at the beginning of the production cycle, say March for corn and soybean production. The final rent payment is made after yields and prices are known for certain. One way to adjust the rental rate for yield and price changes is to determine a percentage of revenue that the property owners will receive. At harvest time, revenue is estimated by multiplying actual yield by an agreed-upon price. The final total rent is calculated by multiplying the estimated revenue by the agreed-upon percentage. The harvest time payment is the final total rent minus the base rent already paid to the property owner. Many ways exist for creating flexible cash leases. Several of these can be viewed in Fixed and Flexible Cash Leases, published by the North Central Farm Management Extension Committee on aglease101.org. Iowa, Illinois, and Missouri Extension also have guidance on how to flex cash leases. The keys to a satisfying flexible rent are agreeing to a base rent, using a well-researched method of adjusting that rent, and understanding what data will be used to make the adjustment. Well-crafted flexible cash leases can remain in effect for many years, allowing risks and returns to be shared between both landowner and tenant.